In this video, I'll be explaining three, or maybe I'll end up with three or four planning strategies post-budget. So we know the budget was announced and delivered by Rachel Reeves of the Labour Party on the 30th of October 2024. Prior to the budget, there was a lot of uncertainty. The most uncertainty that I've seen since I've been within my career in tax. And now that we have certainty, it's now time to look ahead and assess the situation on a case-by-case basis, depending on the circumstances of each individual and family. I must say the budget was, in a way, disastrous for business owners and property landlords as well. You know, the stamp duty land tax increased by 60%, 2 percentage points from 3% to 5% overnight. And for business owners, we know that the total raise of 40 billion, we have 25 billion coming in directly from business owners, particularly around national insurance contributions. Okay, so it's not looking good. In terms of personal thoughts at this moment in time, the budget will definitely not be incentivizing any growth, and you can't tax your way into prosperity. That's the way I see things. For example, the national insurance contributions, one of the reasoning behind it was to fund the NHS, but then you'll have the NHS that will be the biggest loser, you could say, when it comes to paying increased national insurance contributions. So it's like robbing Peter to pay Paul. I have a lot of other views in terms of, you can see this on my other video, in terms of my budget analysis. But this video will talk more about the tax planning opportunities that can be explored. Before we go on, don't forget to like, comment, share and subscribe to our channel. We are chartered tax advisors and we assist clients with high-level inheritance tax planning, trusts, family investment companies, throughout the business owner's life cycle or the business life cycle, so share schemes, R&D, restructuring, so holding companies, demergers, and buying, selling businesses, as well as property landlords, so property portfolio incorporations, commercial property, stamp duty, land tax, and those coming to and leaving the UK. The reason I mention our offerings is because all of these type of individuals in these scenarios will have been affected, and they can also benefit from some of the advice or the tips that I give throughout this video. So the first angle that I want to discuss is around, and it's a massive one, it's a disastrous one, is around the pensions reform. Till now, most likely up until April 2027. And I say most likely because there are still consultations to be had. Okay, so we're not sure the final outcome, but effectively, up until April 2027, the pension pots or unspent pension pots will not be or have not been subject to inheritance tax. And this is a big change, which is from April 2027. Pension pots will come into charge to inheritance tax. Now, what is the impact of this and what are the opportunities? Directly, you could say the impacts are twofold. So, number one is it will have a direct effect on pension contributions. So, whether individuals, working people, business owners are willing to continue, as in, I'm not saying, just hear me out, I'm not saying whether they want to continue or not. I'm just saying that they'll think about it a lot more because pension pots have previously always been part of estate and legacy planning. So, saving for retirement planning, of course, but the estate planning and the legacy planning element has always been there as well. Now, don't get me wrong, you still have the income tax benefits on contributions made. You still have the corporation tax benefits. So, for example, making contributions into a SAS, so it's not all doom and gloom, but the inheritance tax position was always an additional benefit which has now been removed, and therefore naturally those that are affected will assess their situation. And as I say, it's important to take professional advice where we assess the whole situation, because a lot of people won't be affected. So here we're talking about those that will be affected, and that's the initial first step. So what we have then, as I say, is it will have a direct impact in terms of real life circumstances, as I call it, which is, okay, how do we plan for the future in terms of from an estate planning perspective and legacy planning. And the second effect is the fact that more and more individuals will now be pushed above the nil rate band of £325,000. So more individuals will come into the inheritance tax net, and therefore on death 40%. So tax on the pension pot will be at 40%, which is not a joke, right? But also another net negative is the fact that more and more estates will exceed the £2 million threshold. So the pension pot will take them above the £2 million, and therefore following the estate exceeding £2 million, something known as the residence nil rate band, RNRB, which is specifically for main residences that are left to direct descendants at a value of £175,000, so no inheritance tax on the £175,000 value, it begins to taper. So once the estate exceeds £2 million, the £175,000 begins to taper, and therefore by £1 for every £2. So therefore £175,000 times by 2 gives you £350,000, and therefore once an estate exceeds 2.35 million, the £175,000 residence nil rate band is effectively tapered, fully abated. And what this means is that previously you would have received 40%, as in you wouldn't pay inheritance tax on £175,000, and therefore saving tax at 40%. The pension pot coming into the estate would effectively remove that. So twofolds, more people will exceed the nil rate band, and more people will have their residence nil rate band tapered. What are the planning opportunities? One particular planning opportunity, and there are many planning opportunities, I'll give you one in this video. For the rest of them, you need to reach out for a chat. But one of them would be around looking at something known as gift out of surplus income, or gift out of ordinary income, or gift out of excess income. Different terminology, means the same thing. So what one can potentially look to do is effectively withdraw from the pension pot, utilizing the tax-free allowance, which is 25% of the pension pot, and then immediately gifting the funds, so a cash gift to beneficiaries, so the children, the grandchildren. Now, I'm pretty sure, as in case-by-case basis as always, but I'm pretty sure we can argue that this drawdown is surplus income, especially if you have income from elsewhere. So that's the planning strategy. I hope that helps, and you can thank me later. The second angle that I want to discuss in this video is around the business asset disposal relief. Now, I've sat down and I've considered every change in the budget, its impact, and also tax planning opportunities. Naturally, I won't go through everything in this video, but here we'll be looking at business asset disposal relief. Obviously, when it comes to business owners, they've been affected by employers' national insurance contributions, business asset disposal relief, the increase in capital gains tax rates. We have the restriction of business property relief or agricultural property relief to 1 million. We also have the changes around employee ownership trusts and other matters too. Here we'd be looking at business asset disposal relief. I must be honest with you, I was particularly impressed with the delivery of Rachel Reeves' budget. I think it was one of the longest, 1 hour 22 minutes, I timed it, and her delivery was flawless. apart from a few jabs at the opposition party, the Conservatives, her delivery was flawless. And also, again, there was a lot of uncertainty around the business asset disposal relief position. So previously, if you look at its history, we had, I think it used to be called taper relief at one point. I've originally known it as entrepreneurs relief, and many business owners, tax advisors, accountants still refer to it as entrepreneurs relief, which is fair enough. I think it's the same way some people refer to HMRC as the inland revenue still. That's a bit of a new one to me, but entrepreneurs relief is acceptable, and also business property relief. I still call it BPR. For some reason, some have been calling it BR, which is a bit confusing because then you have BR and APR, so you'd rather have BPR. That's a bit off topic though. So business asset disposal relief, formerly known as entrepreneurs relief, it has a bit of history to it. So a good few years ago is at £10 million, and then reduced down to 1 million, which effectively, if we just take a step back, what is business asset disposal relief? It allows for a reduced rate of capital gains tax, which is at 10%, okay, on certain disposals. So of course, qualifying conditions must be met, and this is an area we provide bespoke advice and our opinion in terms of, whether BADR, BPR, APR, whether it will be satisfied or the conditions are met or not. So then it was reduced down to £1 million. Now, again, as we are talking about the uncertainty, we have some individuals were thinking that the BADR would completely be abolished. Some thought it'd be reduced down to 500,000. I was completely certain that there's no chance with this government and the way they're going, which is no incentive for growth, unfortunately, especially at this moment in time. It would never have been increased. So we've got this certainty now. Now, what is the certainty? People are still unaware that, as in they are aware that business asset disposal relief will remain at £1 million, thinking that, oh yes, all is well and good. The fine print then goes on to say that from the next tax year, it will be taxed at 14% rather than 10%, and the tax year following would be at 18%, which is the basic rate capital gains tax band anyway. Okay, so the basic rate capital gains tax went up from 10% to 18%. The higher rate went up from 20% to 24%. So effectively, after 2 years, it will be abolished. So that's the point you need to take from here to begin with. And therefore, we need to start exploring tax planning strategies. Now, the impact, and if we particularly looking at it from a business owner's perspective, is that the shares in a qualifying company is currently subject to 10% business asset disposal relief with a lifetime personal limit of £1 million, right? What we now need to explore is, okay, it's going to go up to 14%, then 18%. How do we sort of, manage this tax risk, or as in the tax burden, or the increased tax burden? The first thing that I always, and this is free advice. This is free advice that we'd usually charge for, but I'm giving this to you in this video. But as I say, don't forget to reach out, because everything is bespoke, case by case. There are always nuances in every tax planning case that we look at. There's always a certain angle that we need to explore in a lot more detail in terms of the technicalities. So what we have is transfer of shares between, so the first point is transfer of shares between married couples, no capital gains tax. Okay, nil gain, nil loss, therefore no capital gains tax. So what you'd want to do is, if you own shares in a trading company or qualifying company, you'd want to explore whether you can transfer shares to your spouse, to your husband or wife, and basically, instead of having a 1 million limit, you have 2 million between married couples. And this is relevant, for many business owners, many trading companies that we work with, when you have valuations of 5 million, 10 million, 50 million, all these small things become relevant and the tax savings can quickly go into the millions. The second point that one can consider is around restructuring prior to sale of business. So this is why it's, again, very important to obtain expert tax advice as early as possible. Sometimes clients come to us right at the last minute and certain structures require time to implement, okay? And also conditions sometimes require time, 12 months, 24 months. One thing that we can potentially look to explore for clients is around a restructuring whereby we insert a holding company above a trading company, and there's a particular exemption known as the substantial shareholding exemption, whereby we can dispose of the shares in the trading company with 0% capital gains tax, okay? So we're not even looking at business asset disposal relief. We're not looking at 10%, 14%, 18%, 24%. We're not looking at any of that. We're looking at 0%. And again, the tax savings, as you can imagine, are significant. Now, just keep in mind though, as I say, with tax, there are rarely circumstances where everything is just a win-win. If there's a win here, then there's a slight drawback there that needs to be monitored, needs to be assessed, needs to be advised upon. So what we have is the funds, the proceeds from sale are sat in the holding company, and this is where we assess your future plans. If you want to explore wider investments, crypto, property, shares and stocks and shares, we'd advise you on a bespoke basis. Sometimes it's a hybrid structure where you benefit from the 1 million each between spouses, and then you also have this linked investment company on top. Again, very bespoke planning, very high level, and therefore advice must be sought. The other angles that can be considered is individuals and or families that are open to or willing to relocate can perhaps become non-UK resident and then dispose of their shares in a UK trading company. Now, fine, it's a UK trading company, but disposing of your shares as a non-UK resident, now this doesn't work with properties, so don't get too many ideas, but disposing of your shares in your UK trading company as a non-UK resident effectively again means potentially 0% capital gains tax. This is something that can be explored. This is something that I personally advise on. So through Aswat Tax, which is our specialist tax advisory practice, but also through Aswat Global, where we assist. In terms of jurisdictions, people are going all over the place. So you have Jersey, Italy, they have a decent regime, Portugal, different parts of Europe. Some people are just going back to their homeland. But the UAE and the GCC region is a fast or a rapidly growing and expanding region in terms of opportunities. And then also, you have the sunshine, which you cannot go wrong. I'm actually shooting this video in Dubai, if you can see behind me. You have the tax-free environment, the safety, no crime, compared to the UK. Again, it's a stark difference along with the sunshine. So people are exploring the UAE, the Kingdom of Saudi Arabia. Again, I'm very heavily involved with the Kingdom of Saudi Arabia and the opportunities that are there. And we set up, company formations, corporate tax, and then international tax advisory and structuring as well. So that's something you can discuss. You can discuss with me. But that's the tax planning point, which is those that are willing to relocate should dispose of their shares post relocation. And again, this is a very specific area: statutory residency test, split year treatment, temporary non-residence rules. This all needs to be looked at. My expertise and my technical knowledge and capabilities are around multiple taxes. We are a multidisciplinary practice, and this is what makes us stand out, where we can have a case and we can look at different angles. As in, you can discuss one particular case and I can talk about so many different taxes. Okay, this is something that I constantly develop myself in. The other planning point, or the final planning point around business asset disposal relief, is for your information. So FYI, the increase in the rates from 10% to 18%, 20% to 24% was on budget day. So those that completed on budget day, unfortunately, they lost out. Yes, tax advisors, ourselves, looking at MBOs, sale to third parties, EOTs, prior to budget day, we were extremely busy. I honestly believe that we'll be even more busier. Corporate finance specialists as well will be even more busier up until the 5th of April. Why? Because the advice there is to expedite the sale process. So I've already had many discussions. We've engaged for 2 clients as well in terms of expediting the sales process prior to 5th of April 2025, where the business asset disposal relief rate will go up to 14%. So that 4% saving is still significant. Now, there are many angles we can look at this, and I always like to take a well-rounded approach. For example, you have to run the numbers. You have to crunch the numbers. So what is the tax saving? What can we do? What can't we do? What are your plans for the future? Is there potential scope to improve certain efficiencies? So this is where the business advisory comes in. Is there certain scope to improve business efficiencies so that, okay, let's just say you're going to make a £40,000 tax saving. Is there anything else we can look at that will rather increase your sales value by 5%? So, there's a lot of angles that need to be considered. But from a tax perspective, one may wish to expedite the sales process. We are on hand. We are a firm of chartered tax advisors. So there's myself, CTA, my colleague CTA, FCCA, ATT. We've dealt with M&A transactions. So please reach out. I'll be talking about VAT on school fees. Before we go on, again, I just need to remind you, don't forget to like, comment, share, and subscribe to our channel. And also, we have the link down below where you can book a call with us, and we can also assist. If you send me an email, we can also begin informal discussions and then take it from there. VAT on school fees to be introduced from 1st of January 2025. Now, it's not to say that I'm supporting the VAT on school fees. I did a lot of reading when it was first thrown out there, and the numbers, again, unfortunately, with a lot of other things that were delivered in the budget, there's that risk, which is that will the expected income from the change in the rules actually materialize, crystallize? We'll come to the non-dom regime very shortly, but even on the VAT on school fees, a lot of the calculations that were prepared were bringing things back to break even. Because you have to remember, there's the admin side as well, okay, VAT returns quarterly and other angles too. So ignoring that and ignoring my personal views, we have the VAT on school fees. Now, usually the VAT on or the payment of school fees by parents are paid out of already taxed income. Okay, so you've already paid income tax at 40%, 45%. You've also suffered national insurance contributions. If you own shares in a trading company or in a property investment company, you've extracted dividends at 33.35% or 39.35%. Sorry, 33.75% and 39.35%. And as I say, you've already paid large amounts of income tax, and then you're paying the school fees, and then you're having to pay the additional 20% VAT. One particular angle, again, that can be explored is around the grandparents. Okay, the grandparents assisting the parents, so their children, in paying for their grandchildren's school fees. Now, the aim here, as in broadly speaking, is that, as in there are many benefits here. One is that, okay, the grandparents are reducing their estate for inheritance tax purposes. Okay, gifts out of ordinary income We're looking at the annual exemption of £3,000 for inheritance tax per individual. And another angle that can be explored is if the grandparents are already shareholders in a trading company, we can look to potentially introduce a discretionary trust. Now, I appreciate there's a bit of uncertainty, and there has been planning that has been undertaken which is not acceptable, as per HMRC Spotlight 62, if I'm not mistaken. But I'm talking more about, the parents, as in the grandparents, already own shares in a trading company. There's nothing to say that they can't extract dividends or transfer shares into a discretionary trust for the benefit of the beneficiaries, which would effectively be their grandchildren. The final point of this video is around the non-domiciled regime, or the abolishment of the non-domicile regime. I'll shoot another video very shortly discussing this in a lot more detail, but effectively from 6th of April 2025, we now have certainty again. As I say, I have many clients, non-domiciled individuals. Prior, our advice was more around the uncertainty and how to manage, but now we know what exactly is going to happen. We have from 6th of April the abolishment of the non-domicile rules. Now, very quickly, the non-domiciled individuals, they as in domicile was always relevant for income tax, capital gains tax and inheritance tax. If we abolish the non-domicile regime, then a lot of non-doms that are living in the UK, they will now be subject to UK inheritance tax on their worldwide assets. So not just the UK assets, previously it was just UK assets. Now it would be their worldwide assets, and therefore a lot of them are leaving the country. Okay, I know there are a lot of people out there that are saying, scaremongering, or they're not actually going to leave. The fact of the matter is they are leaving. I'm talking from a personal perspective and my conversations on the ground, but also certain stats whereby, 2022 X number of millionaires left the UK, 2023, now 2024, 2025, it could be a lot more. So non-domiciled individuals that are directly affected need to obtain advice now, immediately, because they have a very short window, only up until 6th of April 2025. So I'm shooting this November the 9th or November the 10th, 2024. You literally only have November, December, Jan, Feb, March, 5 months to undertake planning. And it's very important that planning is undertaken. Other angles that would be considered is to look at the foreign income and gains rules, which is a 4-year window. As I say, I think the main advice from me here would be around obtaining advice as soon as possible. Every case is bespoke, and we can prepare tailor-made solutions. It's just, as I say, it's important to seek advice now. The other angle would be to explore wider strategies such as life insurance or insurance solutions, and also just understanding your current position, understanding the state of affairs. So what is your situation now, what your situation will be following 6th of April 2025, and then in the long term as well. We work directly with high net worth individuals, business owners, property landlords, those coming to and leaving the UK, so expats overseas as well. How are you affected? This is very important. So my base in the UAE and the Kingdom of Saudi Arabia, we have a lot of these discussions. And also we work with professional intermediaries, so accountancy firms, financial advisors. How are your clients? How have they been affected? It's very important to be proactive in these scenarios. And again, we can seamlessly integrate into your organization and provide the advice that your clients require. Don't forget to like, comment, share and subscribe. I hope you found this video beneficial. You must have found it useful. I gave away free planning tips, free planning advice and strategies. So don't forget to reach out, as I say, case by case basis, and I shall speak to you soon. Contact details are down below. Take care. Bye.